So is your current mortgage deal about to expire? In this video, we're going to look at 5 top tips around remortgaging. My name's Aaron, I'm one of the directors at Create Finance, so let's get into the video. So remortgaging, what is it? So when you take out a mortgage, normally you take that mortgage for a set period of time. So let's say, for example, 25 years. Within that, you take the product for a short period of time, maybe 2 years or 5 years, just as an example. Once you're coming up to the end of that period, the product that you have with that particular mortgage will expire. So you may be on a fixed rate deal and maybe fixed for 2%. Once you come to the end of that period, you then move on to the lender's standard variable rates, and therefore your interest rate on your mortgage may increase. One way to combat that is to remortgage. So, top tip number 1. When is the pinnacle time to remortgage? So historically, we used to look at remortgages 3 months prior to the deal expiring. But due to current market conditions, we are now looking at remortgaging 6 months before. And the reason why we do this is to try and capture the best rate possible as early as possible. So by starting it 6 months before, you allow plenty of time for the remortgage to take place and also to get you the best deal. Now, let's say, for example, you started the mortgage deal 6 months earlier and interest rates were to rise, you would keep on that deal. So when your mortgage does expire, you've then got the right rate. However, the other benefit of starting it 6 months earlier is if interest rates were to drop, there's nothing stopping you from changing your mortgage product before the new mortgage is due to start. So therefore, it benefits you in both scenarios. If interest rates increase, you stick on the product that you took when you originally started the mortgage application. But if interest rates were to drop, you can change the mortgage product. Top tip number 2. When you're coming off your mortgage product, it's always good to approach your existing lender. When you approach your existing lender, they can look at something for you called a product transfer. Now, a product transfer is essentially changing your product which is expiring onto a brand new product with that particular lender. It doesn't need to be on the same terms, so whereas you may have taken a 2-year fixed rate deal before, you could change that to a 5-year deal this time. But by approaching your own lender, it does give you more options when it comes to remortgaging. The reasons why it gives you more options is when you're just changing the product, the lender makes no further assessments when looking at your mortgage. Because your debt is already with them, essentially all they are doing is changing your mortgage from one product to another. And because there's no assessments, they don't need things like your pay slips or your bank statements, because they took them when you originally took your very first mortgage with them. The next good thing about product transfers is they are extremely quick. So when you're looking at a remortgage application with a different lender, that may take up to 6 to 8 weeks for it to go through, and sometimes longer dependent on the lender that you approach. With a product transfer, that can be done pretty much straight away. So if you approached a mortgage broker to look at what options are available for you, if the product transfer was the right option, they can do that pretty much immediately. And therefore, if your deal was to expire within the following month, you can move on to the new deal once your product expires. Another benefit with a product transfer is it could possibly be cheaper than elsewhere. So there are some lenders that reward their existing clients and offer them better deals for staying with them. So you may actually get the best deal by staying with your current lender. Another big benefit of product transfers is if you've experienced some adverse credit within the last few years, because there's no assessments made with product transfers, you're more likely to be approved with your current lender, and that can be at a much more competitive rate than going to a specialist lender if you have got adverse credit in the background. You also may have had a reduced level of income, which can also affect you approaching a different lender. Well, again, with the product transfer, because they don't assess your income, that shouldn't be a problem, and therefore your mortgage should be approved. And the final thing with product transfers is the costs. So with a product transfer, because there's very little paperwork involved, you may find that the charges associated with that type of mortgage are lower because you don't need to instruct any further legal advice. However, if you're wanting to borrow more money, a product transfer might not be the most appropriate option for you. You may be able to get a better deal elsewhere by going to a different lender if you were looking to borrow more money. Top tip number 3. When you're looking at a remortgage, approach a mortgage broker. Dependent on the mortgage broker that you approach, the mortgage broker should hopefully have a comprehensive range of lenders available to them. So if you approached your own bank for a remortgage, the bank can only offer you their products available. Those products may not necessarily be the best solution for you across the market. It may be that those products are a higher rate than another mortgage provider. It may be that your income isn't appropriate for that particular lender. Let's say, for example, if you were self-employed with only 1 year's accounts, that lender might not be able to help you. And you may have also experienced some adverse credit and your lender says no. By going to a mortgage broker, they can look at your whole situation. And as long as you're approaching a mortgage broker that's got access to a comprehensive range of lenders, then you should hopefully be able to get the most appropriate deal based on your circumstances. And the reason why that's the case is if you've got access to a wider choice of lenders, you're more likely to get a better deal. Top tip number 4. When looking at a remortgage, make sure you look at all of the fees associated with that particular mortgage. So the first type of fee that the lender may charge you is something called a lender arrangement fee. That's the fee that the lender charges you to arrange your mortgage. So that can range from anything from £499 right the way up to potentially 2% of your loan balance. The most typical fees are £499 or £999, but again, it does depend on which lender you approach. With that type of fee, you can add it to the mortgage, but you must make sure that you're aware that you are charged interest when that fee is added. And also with the lender arrangement fee, normally when you pay an arrangement fee, it provides you with a lower interest rate. By approaching a mortgage broker, they can make sure that you are choosing the most appropriate mortgage for you and make sure that the fee that you are paying for the mortgage warrants the interest rate that you are going to be charged. Where this can be a problem is if you've got a very small mortgage. Let's say, for example, it's £30,000 or £40,000. If you was to pay £1,000 arrangement fee with that lender, even though that lender may charge you a lower rate, if you looked to mortgage with no fee with a high rate, it may mean that that mortgage is more financially appropriate to you because you're not paying that fee. The next fee is the valuation fee. So when you're looking at a remortgage, some lenders won't charge you a valuation fee to look at your property. That valuation fee determines what your property is valued at. And the better the value, the lower the interest rate that you'll get on the mortgage. When you don't pay a valuation fee, there is no risk because if that property comes back with no or a lower value, if you decide that you no longer want to proceed with that lender, you've not paid any money and therefore you can change your mortgage. Obviously, if the lender does charge you a valuation fee, you do need to proceed with more caution. Again, because if that lender does reduce the amount of valuation of your mortgage and you no longer want to proceed, that money is then lost. Another fee that's associated with a mortgage is a discharge fee. A discharge fee is a fee that's charged when you close your mortgage. Those fees can range from anything from as small as nothing right the way up to £250, dependent on, again, which lender that you approach. That fee also needs to be taken into consideration with your mortgage. And another fee to note, while small, is the CHAPS transfer fee. And that's the fee that the lender charges you to transfer the monies from them to you when the mortgage completes. So with mortgage fees, it's really important that you understand all of the fees that you're being charged to arrange that mortgage, because the more fees that you are being charged, the bigger impact that can have on the overall cost for comparison of that mortgage. Top tip number 5. The final tip when we're looking at a remortgage is whether to choose cashback or free legals. So let's explain both of them. So when you look at a remortgage, some lenders will provide you with a cashback option. Cashback essentially can be money that's paid to you on completion of the mortgage. And that money can be used towards the legal costs of changing your mortgage from one lender to another. Cashback can range from anything from £250, whereas some lenders can provide cashback up to £1,000. Normally when you get cashback, the lender doesn't provide you with a free legal service, and that means that you are then left with that cost. However, there are some conveyancers that will match that cashback, and that's called a cashback remortgage offer. So let's say, for example, the lender gives you £250 cashback. There are some conveyancers that will match that as part of their legal cost, meaning that the legal cost for changing the mortgage is actually zero. A big benefit of using cashback is because you are paying for the service, is you've got more control of that legal process. And because you're paying for that service, you've got more control over the solicitor So if things aren't moving forward, you can speak to your solicitor and make sure things complete as quickly as possible. The other option is free legals. So a free legal package with a lender basically means that the lender will appoint a conveyancer on your behalf and pay for that fee. So whilst on the face of it, it seems a really good deal, there are big issues with free legals at the moment, and a lot of lenders are moving away from offering a free legal option. And the reason why that is because there has been a lot of customer complaints about the time it takes for those types of mortgages to go through. Because you are not paying for the service, you have less control with those solicitors. You are essentially a number in a queue. So if you are using free legals, that solicitor isn't going to prioritise your case over anybody else's. And because you are a number in the queue, until you get to the front, that legal process can sometimes come to a halt. And when that process does come to a halt, it can stop the mortgage process. And therefore, when your mortgage expires, you could be in a position where you go on to a high rate with your current lender because your new mortgage isn't ready. Now, because that service reflects on the lender, because they are providing it to you free of charge, some lenders have moved away from free legals because they don't want to deal with those customer complaints. So again, it's really important when you're looking at either a cashback or a free legal option, you speak to a mortgage broker and they can let you know the pros and cons of both different types of deals. Okay, let's recap. Tip number 1. Make sure you look at your mortgage 6 months prior to your mortgage deal expiring. Tip 2. Approach your current lender when it comes to your remortgage. Tip 3. Approach a mortgage broker who's got access to a comprehensive range of lenders. Tip 4. Make sure you look at all of the mortgage fees associated with taking out that particular mortgage. And tip 5. Look at both the cashback and the free legal option. Okay, so there's 5 great top tips around remortgaging. If you are looking to remortgage, check out this video how you can potentially save yourself £18,000.